Welcome back to a new video of Prime Analysis Investing. Today we're going to talk about the stock Sofi, its earnings, its stock price, and whether you should buy this, hold this, or sell this stock, be worried or be optimistic about its future. So right here, beginning the video, we got the start of it. We have its earnings here from this latest quarter. They reported last Friday, so 7 days ago. If you look at this, their net revenue is up a record 37% to 1.0 billion. Their net EBITDA is up 60%. Their fee-based revenue is up 53%. Their member growth grew at a 35% clip to 13.7 million members, the first time they've ever added 1 million new members in a quarter. Their product growth is up 37%. And their guidance and medium-term outlook got updated. So their financial highlights were they beat EPS by 0.13 versus 0.11. They increased EPS 160% year over year. Their adjusted revenue, like I said, 37% increase. And their EBITDA, and they hit a bunch of milestones with product growth, cross-selling, and their fee-based revenue, because they do a lot of fee-based where they get a loan and they'll sell it off to a third party, and they're taking the fees for the loan, so that's huge for them. Right here, is the Sofi's income statement, and if you're looking at this, like we said, we do a top line, the bottom line analysis of the income statements. So you can see right here, if you look at their total interest income was 25% up. Their interest expense though was 31% up, which obviously we would like to see that a little bit less. But at the end of the day, their net interest income went up 50% year over year. So that's insane profitability from the last quarter last year, which is exactly what you want to see in a stock. If you look here, this non-interest income went up 54% year over year, which is unbelievable thing for their loan platform fees, their technology, and their loan origination, sales, and servicing. So basically, Sofi is a company with a whole circle where you go on there. A lot of people go and they'll pay off their credit card debt because Sofi will give you a loan for 10%, which is less than the 20% credit card companies are going to charge. So that brings them in, and they have this wheel where you can get everything. These are a fintech. You can get your loans, banking, credit card, investing, all in one platform is what brings them better. And they have a new generation of people. So it's people that are like 20s to 30s where they're getting more and more money in their accounts. So this is going to help Sofi in the future. So their total net revenue was unbelievable growth for this company, and I'm just going to take you later and just remember these figures. I'm going to re-show you them and compare them to other banks and how much Sofi is better. And then you go all the way down to the bottom here. This is a one-off, this income tax expense benefit, not expense here, but they kept their expenses in line, and they got their net income up to unbelievable charts from the last quarter, and their EPS they beat on this, which is huge for them. And you have to look at their price targets in the years. Let's get to their balance sheet right now. So this is what you want to see for a company. You want to see them having cash and cash equivalents to go up. Because think about all that cash they could put into short-term investments or mergers and acquisitions and buy companies at great prices. So this is just extra net income that this brings to the company from having this cash here. And they got their debt down by 70%. So say there is a correction or something happening in the market, this company will have to refinance any of this debt at higher rates. They have 70% of it gone, so they're immensely more profitable in the future. And if you look at this, their shareholder equity went up by $4 billion. And their total is unbelievable. That's great. And their total liabilities and permanent equity went up by $14 billion, which is great. Right back to the shareholders in this quarter. So I just want you to take a look at the income statement, the balance sheet, and what they reported and how they beat the guidance. And they had a triple beat on guidance, and think to myself, what in the world did this share price do? If you know anything about happening in the market recently, this is what happened with them. They're down 22% since earnings off that, due to the fact that all the SaaS companies are getting killed in the market right now. Anything from Adobe, Salesforce, to Sofi, even banking now, at least into there. Even though they got unbelievable earnings, price targets upgraded. So I want you to think, why should we be buying the stock today? I want you to just go and think about this for the future, their guidance and everything. Look at how much they beat by. They beat EPS by 5% to 4% of EPS or net revenue right here. So they're great. They always beat. They're very consistent. That's something you want to see in management, consistently beating and sandbagging. And then their EPS here, they smoke these EPSs. Unbelievable all the time. They always beat like 0.2 is what they average beat by. This was actually 0.14. Some scales estimate it higher, but you can generally think that they're going to beat the EPS number by about 0.02 each quarter in and out. Another huge thing, a rule for SaaS companies, is you want your net revenue growth and your EBITDA margin to be greater than 40% whenever you put them together. That shows a strong business model, and you should have confidence in those companies. For example, a company like Palantir is like 130 on the Rule of 40. So this is a thing, and you can see that they've been completely over the Rule of 40, which is a detriment and shown to their business model of how good it is within the future and how good they've stayed among that and how good they're with generating revenue and staying profitable on the bottom line. This is their guidance for the full year of 26 and the quarter one of 26. So basically, they're guiding for a year-over-year growth of adjusted 30% net revenue, 52% EBITDA, 72% net income growth, and a diluted EPS growth of 54%. Now, you need to take in all of these numbers and realize that SoFi sandbags, like I showed you up here, they always beat these numbers for each quarter. So just imagine how they're going to beat on each year. So say you look at that EPS growth, you can think they're going to beat at like by a 0.68 they might be at the end of the year. So they're immensely, they sandbag and they overperform. So they're just an unbelievable company with this. So now I just think of everything I just showed you, all their numbers and whatever they put up. And I want to show you what they trade at right now compared to these other banks and what the other banks are putting up for net income and revenue guidance, due to the fact that they have a 51p compared to JP Morgan and Bank of America. So right now they're trading at 2.43 compared to JP Morgan and 2.72 compared to Bank of America. Now this is based off current P, the trailing 12-month P. You really want to look at the forward P to see like, hey, how's this market valuing this company in the next year? See what's all baked into the earnings. And you can see that they're actually only trading at a P of 1.21 times JP Morgan and 1.56 of Bank of America, which is absolutely nothing. So right now they're really being undervalued by 200%, which is unbelievable compared to these over banks based off of all this down here, because I want you to look at, so their EPS growth this year was 106%, 12%, 19%. Their revenue and EPS guidance for 26 is SoFi's about 5 times the revenue that they're going to be growing at a clip, and this is till 29, these numbers that they have laid out. So this is not just going away a one-year thing, this is in the future. Their EPS guidance, they're trading at a multiple of almost 3 to 4 of these companies, which is unbelievable. And so they should be trading at way higher of a P ratio than they are compared to these companies. Based on price of sales, like I said, they should be trading at 4. And the P, they should really be trading at 3.15 to 2.86. So if you look at these numbers right now, what they're actually trading at compared to these companies, they're unbelievably undervalued by almost based off P, they're like 200% undervalued compared to these companies, which realistically, you should see way bigger Ps for these companies, like I'm going to show you in our projections here. Like my base case, I have the Ps at 50 to 60, which the market is only pricing in a 32. So basically, you can get a double up just based on this PE for the market, because they're basically being treated as a bank, but this whole point of the slides is to show you that they're not growing numbers like the bank. They're growing numbers more like a tech company, which is making them undervalued right now. The other banks may be jealous, but eventually whenever that free cash flow and everything goes up per share in the future, SoFi is going to expand these multiples and go up way in price. So let's just take you through our little quick here. So my base case I'm going to take you through first. I have them growing EPS at 75% next year, and then 40%, 40%, 40%. So above their guidance of 0.60, 0.68, because they sandbag, so they're going to do 2 better on EPS a quarter. So 0.68 is perfect in this. Then they grow up 40% the rest of the years, bring them up to PE of 1.86. So they're going to be, and say you're trading at a midpoint of a 50 PE. In 40 years, you're looking at a 93 share mid price, which is unbelievable. It's about a 34% year CAGR adjusted annually. And if you look at their price right now, $19. So you're going to get this stock at a 4.5x right now. Their bull case is unbelievable. 90%, 50%, 50%, 50%. They really go way higher than numbers, which they've shown in the past they could with their beat and raises they almost do every quarter. Only growing revenue at 35%, and you're going to get them to a 141 share mid price point, which is over a 7x, almost an 8x from the price right now. So this is an absolutely great company that you should buy. with some buybacks in there. And these numbers, the base case is very easy, tangible numbers for them to hit, and they're going to get respected with their PE ratio coming in the years. Now, their base case, obviously, their bank stocks, so they could get hit if companies came in and made for the future better and took away their customers because they offer services like SoFi did, and they're bigger names. They could get hit. But I have them only growing net income at 40%, then going down to 25%, which is unbelievable. And like I showed you before, how good this company is at hitting their numbers, SoFi should have easily beat these numbers. And if it was me today, this is a buy. Yesterday, this was a buy at 26. This is a buy at 22. You should be buying, and you should not be able to get enough of this stock because the amount of upside that this stock has compared to the downside risk with this management, the way Anthony Noto understands the industry and operates, you should love this company and trust in them to beat their numbers and hit and get that PE ratio up. Like I said, they're trading so undervalued right now because they're being valued as a bank stock, but they really grow like a tech stock, and the market's still deciding what to do with them. You always want to buy stocks when the sentiment is bad or the valuations are compressed because they can expand those valuations, and that's one of the easiest ways, just from a valuation label on the company, because the numbers they keep consistently putting up year in and year out is one of the best ways to know that you're getting a good stock, because this PE ratio for them is unbelievably low. So you should trust in this management and buy the stock. Thank you everyone for watching. We really appreciate it. If you just hit the like, and you could subscribe to the channel if you want to see more like this.